Most investors are staring at the same handful of names right now, the same AI darlings, the same mega caps, the same stocks that get screenshotted and passed around on every finance channel every single week. And I understand why. Those stories are real, but here is what that crowding creates. It leaves entire corners of the market completely ignored. Companies with real products, real revenues, real catalysts unfolding right now, trading at prices that do not reflect any of it. That is exactly where I spent the last several days. 6 companies, all verified by me personally before I wrote a single word, all trading under $2. And I promise you, none of these are names you have seen recycled on social media this week. Stay with me because the last company I am going to show you just posted the highest gross margin in its entire history, and a director went into the open market last month and bought shares with his own personal money. That is the kind of signal I pay attention to. Before we go anywhere, I am not a financial advisor. This is not financial advice. Everything I share today is for educational purposes only, based on public filings and company announcements. These are high-risk, speculative stocks, and you could lose your entire investment. Always do your own research and consult a licensed financial professional before making any decisions. Now let us get into it. Here is the thing about July 2026 that most investors are missing. The crowd is focused on the same handful of mega-cap names, the same AI stories, the same charts that have already run hard, and that crowding creates something valuable for investors willing to look somewhere else. It leaves entire corners of the market completely ignored. Companies with real products, real revenues, real catalysts happening right now at prices that do not reflect any of it. That is exactly where these 6 companies live. Let us start. 2 brands, 1 company, and a transaction that happened just over a month ago that most investors have completely missed. One of these brands was founded by a dermatologist and has been sold in more than 70 countries for over 30 years. The other is a cult makeup brand loved by beauty editors and celebrities worldwide for its clean formulas and bold identity. A company brought both of them together in 2022, took the whole platform public on Nasdaq, and built what it called a global beauty powerhouse. Then something unexpected happened. On June 1st, 2026, just over a month ago, this company announced it was selling the medical skincare brand, not for a small number, for $460 million, $366 million in cash at closing, $30 million in vendor notes, and up to $64 million in additional earnout payments. The proceeds will pay down roughly $178 million in senior secured debt, essentially cleaning the balance sheet in a single transaction. What remains after the sale? 1 brand, a makeup company with over $110 million in revenue in 2025, positive EBITDA, a cult following among younger consumers, and now a debt-light company with room to grow. The analyst who covers this stock just raised their price target to $2.28. The stock is still trading near $1.55. A company just sold one of its brands for $460 million, and the stock has not caught up yet. The company is Waldencast plc, ticker symbol WALD, listed on Nasdaq. Now imagine losing the use of your arm after a stroke, not being able to feed yourself, not being able to get dressed in the morning. Millions of Americans live with upper limb paralysis every single day. Stroke survivors, veterans with traumatic brain injuries, people with spinal cord damage. For decades, the options were physical therapy, adaptive tools, and learning to live with it. Then a group of engineers and scientists from MIT and Harvard in Boston decided to build something completely different. A powered brace worn on the arm that reads the electrical signals the muscles still produce, even when the arm is paralyzed. Those signals, still present even in severely weakened limbs, get picked up by the device and used to power a motor that physically moves the arm. Not a robotic arm attached from the outside. Your arm, responding to your own body's signals. The FDA registered it as a Class II medical device. Medicare covers it. The Veterans Administration buys it for veterans. And this year, the company began expanding access through a major national orthopedic care network. In Q1 2026, revenue came in at $10.1 million, beating analyst estimates by over 9%. Gross margin hit 68.2%, the highest this company has ever recorded. And in June 2026, a director of this company went into the open market and personally purchased 40,000 shares with his own money. not a stock option, not a compensation package. A personal open market purchase. 4 analysts cover this stock. All 4 rate it a buy or strong buy. The average price target is $4.42 against a current price near $1.04. The company is Myomo Inc., ticker symbol MYO, listed on NYSE American. Las Vegas, 2011. A group of gaming industry veterans sit down and ask one question that nobody in mobile gaming had seriously considered before. What if the rewards inside a mobile game were actually real? Not digital coins, not fake badges, real hotel stays, real show tickets, real dining experiences at actual resort properties that people actually want to visit. They built the technology from scratch, signed deals with major resort and entertainment brands across the country, and created something that had genuinely never existed before, a gaming loyalty ecosystem where players earn real-world experiences through mobile gameplay, social casino games, card games, solitaire, all powered by the same loyalty engine underneath. The company went public on NASDAQ in 2021. Annual revenue reached $235 million in 2025. Gross margin sits at 75.6%, exceptional by any standard in the gaming industry. The company generated $26 million in positive free cash flow last year. It is completely debt-free. And here is the part that made me stop and read the filing twice. The company holds more cash than its entire market capitalization right now. The stock is trading at a valuation smaller than the cash sitting in its own bank account. The stock fell below $1 in late 2025 and received a NASDAQ compliance notice, but the business underneath that stock price is real, profitable, and generating serious revenue. 2 analysts carry a buy rating with a price target of $3. The stock trades near 50 cents. Next earnings are August 3rd. A catalyst is coming soon. The company is Play Studios Incorporated, ticker symbol MYPS, listed on NASDAQ. If this kind of research is useful to you, verified stories, real numbers, nothing recycled, hitting subscribe genuinely helps me keep doing this every single week. It takes 2 seconds. Okay, back to it. Right now, out in the Atlantic and Pacific, there are autonomous platforms floating on the ocean surface, generating their own electricity from ocean waves, running sensors and cameras and communication equipment around the clock, monitoring maritime activity, with no human crew anywhere near them. The US Department of Homeland Security contracted this company. The US Coast Guard placed real purchase orders this year, and in 2026, their systems were integrated with Lattice, the AI-powered defense operating system built by Anduril Industries, one of the most closely watched defense technology companies in America right now. This same company builds an autonomous surface vessel, an unmanned patrol boat that covers coastlines and gathers maritime intelligence without anyone on board. International defense clients in Northern Europe have signed on. A Nordic underwater research institution placed an order for immediate delivery. The company just completed a $10 million capital raise to fund operational expansion, and here is something worth marking on your calendar right now. This company reports earnings on July 15th, 2026. That is 12 days from today. A catalyst is arriving faster than most investors realize. Analyst price target sits at $1.50 against a current price of around 27 cents. The company is Ocean Power Technologies, ticker symbol OPTT, listed on NYSE American. Tens of millions of Americans live with chronic lumbar disc disease. The discs between the vertebrae break down, compress, and the pain radiates down the leg for months, sometimes years. Standard medicine offers 2 answers: manage the pain with medication or surgery. And surgery helps some people, but not all. Nobody had found a way to actually repair the disc itself until one company in New York set out to do exactly that. Founded in 2008, they built a therapy called BRTX-100, using stem cells drawn from the patient's own bone marrow, cultivated in a low-oxygen environment specifically designed to mimic the disc, and injected directly into the damaged tissue. In their completed Phase 2 trial, 52% of evaluable patients achieved at least 50% improvement in both pain and function at 52 weeks. That data was presented at the International Society for Cell and Gene Therapy annual meeting meeting in Dublin just 2 months ago. In May 2026, a Miami-based activist hedge fund called Chaos Capital filed with the SEC disclosing a 4.9% ownership stake. That is an outside investor, with their own money, making a formal public declaration that the market is pricing this company wrong. Roth Capital maintains a buy rating. The average analyst price target is $8 against a current price of 33 cents, 2,000% upside according to the analysts who cover it. And now the same company, same ticker, same stock, has a second program I need to tell you about, because this one earned 2 spots on this list. Most people know white fat, the kind that stores energy. Very few people know that brown fat does the exact opposite. It burns energy. It generates heat. Scientists have believed for decades that it could be harnessed against obesity and metabolic disease. This same New York biotech has a completely separate platform called ThermoStem, using brown adipose-derived stem cells to generate functional brown fat in patients with obesity and type 2 diabetes. Instead of suppressing appetite the way GLP-1 drugs do, this approach rebuilds the body's own energy-burning machinery from the inside. In 2026, the company launched a commercial biocosmeceutical product line, partnered with a physician network for independent clinical validation, and completed a key manufacturing milestone. Same activist fund at 4.9%, same Roth Capital $8 price target. 2 platforms, 2 completely different diseases, 1 ticker at 33 cents. The company is BioRestorative Therapies Inc., ticker symbol BRTX, listed on NASDAQ. 6 companies, all under $2. Let me put every single one on the table right now. Waldencast PLC, ticker WALD on NASDAQ, sold 1 brand for $460 million. Milk Makeup remains, analyst target 228, stock near 155. Myomo Inc., ticker MYO on NYSE, American. Powered arm brace for stroke survivors and veterans, 68% gross margin. Director buying stock personally, analyst target 442, stock near $1.04. Play Studios Incorporated, ticker MYPS on NASDAQ. $235 million in revenue, debt-free, trading below its own cash balance, analyst target $3, stock near 50 cents, earnings August 3rd. Ocean Power Technologies, ticker OPTT on NYSE American, Autonomous Ocean Defense, Coast Guard contracts, Anduril integration, earnings July 15th in 12 days, analyst target 150, stock near 27 cents, and BioRestorative Therapies Inc., ticker BRTX on NASDAQ, Phase 2, complete for chronic disc disease, ThermoStem platform for obesity, activist fund at 4.9%, $8 analyst target, stock at 33 cents. 2 spots, because 2 completely independent programs on 1 ticker, earning a 2,000% analyst upside target, deserves 2 spots. Now the honest part, because I will not send you into any of these without telling you exactly what could go wrong. Waldencast's Obagi sale is not yet closed. Until Q3 2026 closing, regulatory complications remain possible, and Milk Makeup has been seeing declining international sales. Myomo depends heavily on Medicare reimbursement policies that can change with any government decision. Play Studios has declining revenue trends despite its strong cash and balance sheet position. The operational numbers are moving in the wrong direction even as the financial foundation looks solid. Ocean Power Technologies has under $6 million in annual revenue. Losing even 1 or 2 government contracts could significantly change the entire picture. And BioRestorative Therapies has a market cap under $4 million, one of the smallest, most speculative companies I have ever put on a list. They need to keep raising cash, and every capital raise dilutes existing shareholders. These are not safe investments. Every single one carries real risk of significant or total loss. Read the SEC filings. Understand the cash runway. Know what you own. That is the list. 6 companies, all under $2, all with stories the crowd has not found yet. A beauty company that just sold a brand for $460 million and the stock has not caught up. A medical device giving paralyzed arms back to stroke survivors with a director buying shares with his own money. A gaming loyalty empire with 235 million in revenue trading below its own cash balance. An autonomous ocean defense company with Coast Guard contracts and earnings arriving in 12 days. And a biotech with two completely separate disease programs, a 2,000% analyst upside target, and an activist hedge fund sitting at 4.9% watching closely. This video is for educational and informational purposes only. Nothing here is financial advice. These are high-risk speculative stocks, and you could lose your entire investment. Always consult a licensed financial advisor before making any investment decisions. If this research was valuable to you, hit the like button, subscribe, and drop a comment below telling me which of these 6 you are going to research first. I read every single one. See you in the next video.